How did CDOs and CDs amplify the 2000 financial crisis? Imagine a house of cards built on shaky ground that suddenly collapses, causing chaos for everyone involved. That's what happened during the financial crisis of 2008. Two financial tools called collateralized debt obligations and credit default swaps played big roles in making the crisis worse. Let's break down how they worked and why they caused such a big economic mess. Collateralized debt obligations are like giant bundles of mortgage loans that banks created. They took many home loans, especially risky ones given to people with poor credit, and packed them into these bundles. These bundles were sliced into different parts called tranches. Some were rated as very safe, like AAA, while others were riskier. The idea was that by mixing many loans, the risks would cancel out. But in reality, when housing prices dropped across the country, many homeowners defaulted on their loans at the same time. This caused huge losses on these bundles. Rating agencies had given high safety scores to some of these risky parts, which made investors believe they were safer than they really were. This led banks to sell more of these risky securities, encouraging more risky lending. Credit default swaps are like insurance contracts for these mortgage bundles. Investors bought CDs to protect themselves if the mortgage securities failed. Some bought them to gamble on the securities' failure. The problem was that the market for these swaps grew to be worth trillions of dollars, much more than the actual mortgage assets. When defaults increased, the sellers of these swaps, such as insurance companies and banks, faced enormous payouts they couldn't cover. This caused many financial institutions to struggle or even fail. Because these swaps connected many banks and companies, trouble in one part of the system quickly spread to others. Together, CDOs and CDs made the crisis worse in several ways. Banks issued more risky loans because they could sell them as CDOs and transfer the risk. The complex structures and false ratings hid how risky these investments really were. The interconnectedness created by CDs meant that if one big bank failed, it could trigger a chain reaction. As defaults rose and the value of these securities dropped, confidence in the entire financial system evaporated. Markets froze and panic set in. This led to a sharp decline in lending, a credit crunch, and a deep economic downturn that lasted 4 years. In the end, the story of CDOs and CDs shows how financial innovation, without proper oversight, can turn small problems into a global crisis. Their role in the 2008 crash reminds us why transparency and careful regulation are so important in keeping markets stable and avoiding future disasters.